Welcome to Pro Trader Strategies Market Commentary for Wednesday, February the 3rd. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. We have had some economic data come out this morning and probably caused a little bit of downward pressure in the market. As we all saw, the market opened up higher and then fell off pretty rapidly. We did have the ADP non-farm payroll number, which isn't the main number that comes out on Friday. That is the non-farm payroll also, but it came in slightly higher than expected. But the big one was final services PMI came in lower than expected at 53.2, slightly above the 50, which shows a bit of expansion. And the ISM, the Institute for Supply Management, non-manufacturing PMI, which is the Purchasing Managers Index, came in slightly higher than expected at 53.5, but it was like an 18-month low, and that was lower than expected. Crude oil inventories came in at 7.8 million barrels, and it doesn't look like anybody is going to turn off the spigot on this oil. As a matter of fact, Iran is looking at increasing their production by double. So now that they're allowed to throw it out there, they are trying to do a little bit of catch up, it seems like, and really throwing oil out onto the market. So oil has actually showed a bit of support here and isn't really participating in the widely seen sell-off that we've seen. As you can see, I just threw up a chart of the bonds. The bonds obviously have been rallying. Fade the Fed is the mantra here in the bonds, and ever since the FOMC raised rates, they have been lowering rates in the overall market because they're trying to signal to the Fed, hey, the overall economy is not doing that well. Although it has seen a bit of resistance up here, and we've started to come off as the equities started to push higher off the lows. As you can see here, the NASDAQ well below the value area low. I talked about this yesterday. That would act as support. It did, but once we woke up this morning and opened the markets, it broke through that value area low and is coming down here. This is going to act as a support area. As you can see, it's several times bounced off of there. So we'll have to look and see if that's going to hold today. Same thing on the chart for the E-mini S&Ps. As you can see here, E-mini S&Ps just, we came in, rallied up, but right on the open, just sold off. But when those bonds started coming off their highs, the equities started showing a bit of support, as shown in this chart here on the E-mini S&Ps, which is a daily broken down into 15-minute segments. And this is a much tighter, more concise market profile or monkey bars here. So it's showing less time frame. The other ones that I was showing you on those charts was a lot more inputs. This has a more tighter input ratio, so it's going to show it just for the last couple of weeks rather than the last several months. And this is the value area or the point of control for the E-mini S&Ps on the shorter duration chart here. And we've tested that value area and failed just recently. So this is where the bonds started coming off their highs. We started to rally, but it looks like we are starting to slowly trickle off of those, off that point of control, which means the bears are in control. A couple of trades that I did, I was talking about this. I haven't been adding a lot of long-term trades to my portfolio just because we're in earnings season. I am pretty close to the margin max, so I need to save a little bit of room for some of these different earnings trades. And Yahoo, Yahoo's just been failing. It's kind of like the new AOL, if you will. And Yahoo, ticker symbol YHOO, I went in there and did the February weeklies with just a couple of days to go and sold the 31.5 calls for 35 cents. Bought them back this morning for 3 cents off of that down move there. Right off the opens when I covered those. I'm going to be looking at a couple of earnings trades later today, but I haven't really delved into that very much. And in WYNN, similar situation where I went in there in the weeklies and sold some calls. The reason why I sold some calls, even though Las Vegas Sands came out with better than expected earnings just a few days ago, they sold off on that. So I was looking at that as being just people wanting to get out of this sector for the most part, even if they were doing good on earnings, probably because if the overall economy is not doing well, the extra money that people have saved is not going to be thrown down on the roulette table. So going forward is why I looked at that. Earnings are a lagging indicator for all intents and purposes. So I did the February 67.5 calls, sold them for 65 cents, bought them back this morning for 30 cents. The market did sell off after that. It opened up a little bit higher and started coming off, and that's when I covered them. Probably a little bit early, but it was only about 10 cents or so I wasn't too worried about that. Going forward, Friday, we have a webinar on synthetic long calls. We did last Friday's webinar was on synthetic synthetic short stock. Friday's webinar coming up, we're going to be doing it on synthetic long calls. So we're going to talk about how you can create different types of scenarios with the long stock. Say, for instance, you wanted to do 100 shares. That's a pretty easy one. But I'm going to be talking about if you only wanted to do maybe 50 shares of the underlying. We know that options have, for every one contract, is equivalent to 100 shares of stock. I'm going to show you how you can make that a little bit even less than 100 shares of stock. So that should be a really good one to check out because not everybody wants to put 100 shares or 1,000 shares in their portfolio. So I'm going to show you how to play around with those numbers a little bit and not make it so margin intensive as well. That's the beauty of using options on the synthetic long stock, is that you're using less than half of the margin required for just buying those stocks outright. So that's a really good one, especially for smaller accounts or newer traders that are taking control of their portfolio. All right, that's about all I got for you guys today, other than if you can't take that, take it easy.